So we move to chapter 5, overheads. You'll note that for this particular chapter, we've broken it down into a series of parts. So there's several reasons for that. The first reason is that there's quite a lot of information in this chapter, and if you're new to management accounting, you may find it tricky to grasp all the concepts, really on the first or second sort of chance. Outside of that, it's a chapter that the examiner tends to favor. So we thought we'd slow it down a little bit for this chapter. I hope that makes sense to you. Let me explain further as we go through each of the parts. So let's look at the first here. We're talking about overheads. Now, I think you'll be familiar with that word. Now, let's split that into several different parts, really starting with this section 1 and direct and indirect expenses. Now, if you do have MA experience, this may be very straightforward. Do bear with me. So when we think about expenses, really, we're talking about areas of expenditure, if you will, that in effect decrease economic benefit during the period. We're talking about an outflow, a depletion of assets, or really in some way a sort of a worsening of your liability position. So your liabilities increase. Okay. Now, what we mean by that is either, expenses will be incurred in the form of, let's say, cash or bank, or possibly on credit. That would create a liability. So let's note that, and this sort of links in with double entry to some extent, although double entry isn't a specific requirement for us in the MA syllabus, a small amount of it, not a lot. So when we talk about expenses, really, we're talking about the reduction in an asset noting being something that we own, or an increase in a liability, as I've just mentioned. So for example, we buy X product, and indeed we buy it on credit, therefore our liability or our trade creditors or our accounts receivable increase. Okay, so that's the essence of an expense. I mean, broadly speaking, if we're talking about reduction or decrease in economic benefit or creation of liability, an expense would be classed generally as negative. Okay. Now, moving from there, when we talk about function or classifying expenses by function, given the sort of emphasis within MA on manufacturing, let's talk about some examples. So, let's say buildings management, typical expenses that you will see here, rent, gas, electricity, etc., telecoms, possibly taxes on the property. So everything related to the management of a business, a building even. Production, okay? So when we talk about production, let's say we're manufacturing product A, clearly areas such as repairs to machinery, maintenance of machinery, or possibly the lease or hire costs relating to machinery that is used in production. Outside of that, when we think of selling and distribution, obviously we're talking about things like advertising, perhaps marketing, some form of customer service unit, let's say, or indeed logistics and delivery of some kind. Last sort of main example would be finance and legal. I guess that's where we come in, but we're talking about things like interest, possibly legal or professional fees, perhaps an audit, possibly insurance, etc. So a number of different functions by which expenses could be classified. Okay? Moving from there, let's note that when we think about expenses, as we said up top, various functions within a manufacturing business, they may be direct or they may be indirect. Now, the classification is quite straightforward because when we think of direct expenses, we're talking about expenses that are easily directly attributable to a specific product or service. Let's say, for example, a component, part, or element of a product. Now, the reverse, obviously, is something that is indirect. In other words, it cannot be attributed to a specific product, also known as overheads, generally speaking. Okay, but also, obviously, you could have something that was a direct overhead. Moving from there, when we think about the treatment of direct and indeed indirect expenses. Now this is key, and we'll see this examined in OT questions fairly regularly. Watch out for this definition of prime cost. What do we mean by prime cost of a product? Well, let's note direct materials, direct labor, and direct expenses. Indeed, each of these are really expenses, but we're classifying them in a more sort of drilled down sense. Now let's note that where these areas, materials, labor, and expenses are direct, they're known as the prime cost of the product. Outside of that, when we think about the total cost, because remember, the prime cost isn't the total cost, because what we would add to the prime cost of the product is some form of share of overheads. Now you recall what we said up top is that overheads can come in a number of different forms. They may be direct, but they may also be indirect. So that allocation, or if you will, that split up of overheads is important. So let's note the difference between these two definitions. One, clearly the prime cost, direct, and one, the total cost, i.e. prime cost plus the share of overheads. Let's move to this next area now. Absorption costing, we'll note from the MA syllabus, is a key area. It's a key area for us. We must understand it. In fact, costing is important for your success in this exam. Don't avoid it. So this second section of this particular chapter 5 is just really absorption costing across the board in a number of different ways. Let me explain further. First things first, the absorption costing process, what do we mean by that? Well, when we think about costing, we know that costing is important, as we'll see below, for just a number of different reasons. We need to be able to establish costs accurately. This is just one method. So what is this method? Well, it's a process that involves sharing overheads between different products. Okay? Now, what's the purpose of absorption costing? Well, pretty similar to the purpose of most costing techniques, but let's be specific here. It's to ensure that the total cost of production also reflects the indirect costs. In other words, what we're trying to do is to absorb into different products some areas of expenditure, of expenses that aren't, strictly speaking, direct, or they weren't easy to establish. They're more overhead based. Okay? So that's the sort of intro to absorption costing. What about the steps? So, I'm running a manufacturing business. I've decided to adopt absorption costing. What does that involve? Well, first things first is, overhead allocation. So really, a production overhead is allocated or charged to a cost center if the whole amount of the cost can be specifically related to a single cost center. In other words, if we believe that this particular overhead cost is, broadly speaking, direct, let's allocate it. Outside of that, in terms of the second step, note the terminology here: apportionment and indeed reapportionment. Yeah. So here in this second step, if it's impossible to allocate the whole cost of the production overhead to a single cost center, then the cost must be shared out, or, if you will, apportioned to all the cost centers that contribute to that cost fairly. So there's the essence of it. How do we do it fairly? Some costs were easy to allocate to that cost center, or let's say to that product. Some aren't. So we've got to find some sort of allocation method. So next area for us is overhead absorption. So really, here's the step where we say, well, overhead absorption process is to calculate some sort of production overhead absorption rate. Note OAR for short. So this is the rate in which overheads are absorbed into the cost of each unit, or the cost center, or a particular product. So let's note that three-stage process. Okay? getting to the end where we have to come up, or we decide, well, listen, we need an overhead absorption rate. Okay? Moving from there, in terms of this raison d'etre behind calculation, well, we know why we need it, because we've got to split costs up. But is there anything else? Well, as I said up top, certainly the total cost per unit is critical to us. We must get that right. Why? For two main reasons. First things first is that the cost is going to drive selling price, okay? And indeed, if we get the selling price wrong, it's highly likely that consumers won't buy. Therefore, we won't be profitable. So, common sense first and foremost. But secondly, and indeed probably as important, is this area of calculation of inventory. Now, that may lose a little bit in translation. Now you may be thinking, well, why is it important? Well,